Hello and welcome to this video Behavioral Finance, Examples and Outlook. This is the follow-up video of Behavioral Finance, overview and basic concepts that you have probably watched in the first place. To briefly wrap up what was presented in the previous video. When touching the topic of behavioral finance, it is important to emphasize the role of cognitive biases. Cognitive biases are systematic errors in thinking or judgment that occur when individuals process information in a way that deviates from rational or objective reasoning. Here are some common biases that participants in the financial markets experience. Confirmation bias. Confirmation bias is the tendency to seek out information that confirms one's existing beliefs while ignoring information that contradicts them. Traders who suffer from confirmation bias may ignore warning signs or overlook important market data, leading to poor investment decisions. For example, an investor who works in the automotive sector assumes that stock prices of car companies outperform other sectors. The investor constantly tries to find patterns why one industry outperforms another, so to speak. You see what you want to see. Availability bias. Availability bias is the tendency to overestimate the importance of information that is already available, while ignoring information that is more difficult to access. In the financial markets, this can lead to the creation of market narratives that are based on incomplete or inaccurate information. For example, an investor looks only at the chart in very narrow time frame. For example, an investor neglects previous peaks and troughs, since in her analysis only misleading short-term trends are taken into account. Herd mentality or herd mentality bias is the tendency to follow the actions of a larger group, rather than making independent decisions. Traders who suffer from herd mentality bias may follow market trends without carrying out their own analysis, leading to poor investment decisions. The ultimate result of herd mentality is an asset bubble. An asset bubble is nothing but the proliferation of a false trend by the entire market. Loss aversion bias. Loss aversion bias is the tendency to feel the pain of a loss more acutely than the pleasure of a gain. Traders who suffer from loss aversion bias may be risk averse and may miss out on potential investment opportunities. Another example would be, investors have the tendency hang on to a position that performs badly, in the hope that a reverse occurs. The avoidance of materializing a loss now might lead to even higher losses in the future. We discussed this bias already in the section of the previous video where we discussed the prospect theory. Anchoring or anchoring bias is the tendency to rely too heavily on the first piece of information received when making decisions. Traders who suffer from anchoring bias may make investment decisions based on outdated or irrelevant information. For example, investors look at the previous peak of a product and assume that it will remain so in the future, even though there is no reason for that. The Japanese stock market has never reached its all-time high again to this day. Next, the gambler's fallacy is a cognitive bias that occurs when individuals believe that past events in a random process influence future outcomes, even though they are independent. For example, investors may believe that a stock or asset that has experienced a long period of losses is more likely to rebound or experience a price increase in the future. However, in reality, past performance does not necessarily predict future performance, and each event is independent of the ones that came before. Same is true in the reverse case. Investors may believe that a stock or asset that has experienced a long period of gains is more likely to continue rising in price. This can lead to chasing the trend, buying the stock at a high price, and risking a loss if the trend changes or the market corrects. Overconfidence bias. Overconfidence bias is the tendency to overestimate one's own abilities and underestimate risks. Traders who suffer from overconfidence bias may take on too much risk or engage in excessive trading, leading to poor investment performance. For example, an investor gains confidence from a successful previous trade that was rather owed to luck and not to skill in the own analysis. Similar to the overconfidence bias, we can examine the following for the Dunning-Kruger effect. The Dunning-Kruger effect is a cognitive bias where people who lack knowledge overestimate their abilities and tend to be overly confident in their judgments. For example, overtrading. Novice traders who lack experience and knowledge in the markets may overtrade. Overtrading usually benefits the broker. Another example would be failure to diversify. Investors who believe they have a good understanding of a particular market or sector may invest too heavily in it, failing to diversify their portfolios. These are just a few examples of the many cognitive biases that can affect decision-making in financial markets. By understanding these biases and developing strategies to mitigate their impact, traders can make better informed decisions and improve their performance in the financial markets. Behavioral finance is a field that is constantly evolving as researchers and practitioners continue to uncover new insights into human behavior and decision-making in the financial markets. Here are some of the latest trends in behavioral finance. The impact of technology. Advances in technology are changing the way investors access and process financial information, and are also creating new opportunities for behavioral biases to influence decision making. For example, social media platforms can amplify herding behavior and create bubbles, while algorithmic trading can exacerbate market volatility. The influence of culture. Behavioral finance research is increasingly exploring the role of cultural factors in shaping financial decision making. For example, research has found that cultural differences can impact risk-taking behavior, with people from more individualistic cultures generally being more willing to take risks than those from more collectivist cultures. The importance of financial education. As the field of behavioral finance becomes more widely acknowledged, there is increasing interest in educating investors and financial professionals about the principles of behavioral finance. This includes developing new tools and resources to help investors better understand their own biases and make more informed investment decisions. The rise of sustainable finance. There is growing interest in the role of behavioral factors in shaping sustainable finance, including the impact of values and social norms on investment decisions. Research has found that investors are increasingly considering factors such as environmental, social, and governance (ESG) criteria when making investment decisions. Alright then, we hope you liked this video. Thank you for watching and keep in touch.